Alright, listen. If you've ever taken a trade and later thought, why did I even enter that? This video is for you. Most traders don't actually lose because their strategy is bad. They lose because they don't have a clear checklist before entering. So in this video, I'm breaking down my exact pre-trade checklist, the universal model I personally use before I click buy or sell. No prediction, no guessing. Precision over prediction. Let's get into it. First thing I want you to understand is this. Price isn't random. The market moves with intention. It moves from liquidity to liquidity. Our job as traders isn't to guess direction. Our job is to wait, and then align ourselves with the move that already wants to happen. That's what this entire model is built on. Everything starts with key levels. And if you take nothing else from this video, take this. If price is not at a key level, there is no trade. The key levels I care about are pretty simple. External range liquidity, internal range liquidity, fair value gaps, range highs, range lows, swing highs and swing lows. That's it. Price needs to be trading into one of these areas. If price is just floating in the middle of nowhere, I'm not touching it. So right here on the chart, I'm not thinking about entries yet. I'm literally just asking one question. Where is price relative to my key levels? You can see price pushing straight into external range liquidity, and it lines up with a fair value gap right here. Now my interest is there. Before this, I didn't care. Now here's where most traders mess up. They see price hit a level and they just jump in. We don't do that. Once price hits a key level, I want confirmation. I want the market to show me what it wants to do. The confirmations I look for are simple. Candle 2 failing to close inside candle 1. Candle 3 closing beyond candle 2's open. Or candle 2 tapping the level with just a small wick. These candles are telling a story. They're telling you whether price is being accepted or rejected. Watch this sequence right here. Candle 1 forms. Candle 2 taps the level but doesn't close back inside. That's my first clue. Then candle 3 closes beyond candle 2's open. At this point, the market has made a decision. I'm no longer guessing. Now this part is important. Every trade needs a point where you say, okay, I'm wrong. Invalidation happens when price reacts aggressively at equilibrium. You get a big wick against your direction, or structure breaks against your setup. If any of that happens, I'm out. No emotions, no hope. See this wick right here? That's not a maybe. That's invalid. The model is broken. I move on. Equilibrium is just the 50% of the previous candle. In a bullish setup, I want wicks staying in the upper half. In a bearish setup, I want wicks staying in the lower half. Once price starts aggressively tapping equilibrium, the setup is done. This is where entries get clean. I don't like chasing price. I let price come back to me. I'm looking for fair value gaps inside the previous candle's range that line up with higher time frame opens, weekly, daily, or 1 hour. That refined gap becomes my pullback zone. You'll see price expand, pull back into this gap, and then continue. That pullback is the opportunity, not the breakout. Higher time frame gives me direction. Lower time frame gives me entry. If daily is bullish, I'm not looking for shorts on the 5-minute. I drop down, wait for structure, and refine my entry inside lower time frame price action. SMT is extra confirmation. If one asset makes a higher high and the other doesn't, that's telling you something. It's not mandatory, but when it's there, it adds confidence. Trading isn't about winning every trade. It's about trusting your process, especially when results test your patience. Discipline beats fear. Consistency beats luck. If this helped you, do me a favor. Like the video so it reaches more traders. Subscribe to VTrades if you want more breakdowns like this. Don't predict the market. Align with it. I'll see you in the next one.